September 2020 was a particularly dismal month for investors. All three major US indexes posted their first monthly loss since the beginning of the pandemic in March. And the SIBO volatility index, often used to gauge the market's fear, spiked above 30 for the first time since mid-July.
I think this near-term period where we have not only COVID winter, but significant policy uncertainty about the United States, when you can't be certain who will be the president of the United States, what party will be in control, then you're going to have some elevated volatility.
The market typically slows a little leading up to an election and reacts more positively in the short term when a Republican president is elected.
The stock market and the political environment clearly are closely interrelated, and the stock market reacts generally to political news, and the stock market watches the outcome of an election and the presidential election in particular very closely.
Trump tax reform, tax code changes. I mean, I criticize aspects of it on fairness grounds, but the stock market looks at earnings, and that tax plan was a huge gift to corporate earnings.
Remember though, only 52% of American families are invested in the market. Long-term policy has a bigger impact on the economy than market performance. The economy has historically performed better under a Democratic president. The GDP grew 1.6 times faster on average, and private sector job growth was nearly 2.5 times faster on average under the Democrats. But the election can be an important element for those looking to earn big in the market. So how does the US election impact the stock market, and how can investors prepare? Historically, the stock market slows down and shows a weaker performance in the period leading up to the election. On average, the equity market showed less than a 6% gain during the election years, compared to an 8.5% gain in any other given year.
The stock market hates uncertainty, and of course, election is the ultimate in uncertainty. I think particularly after 2016, when people expected one result and we got a different result, or after 2000, when you had an extraordinarily tight race and you saw the market go down after that. These are reminders that this is a piece of uncertainty which you really can't minimize.
And that uncertainty and the fear of what is to come would generally depress the valuations, which would translate into potentially lower returns in the year before an election is to take place.
However, despite a more modest return, stock performances during an election year have done well. Across the last 7 presidential election cycles, average gains for major indexes like the S&P 500 and Dow Jones showed positive returns in the 6 months before Election Day. The only exception being the 2008 financial crisis that rocked the stock market right ahead of November. Despite the concerns over market volatility following the market performance in September, experts reassure that volatility is just something to be expected at this time of year.
Typically, market volatility, or at least volatility implied by the options market, will be elevated ahead of an election and generally resolved following an election if an election result is indeed conclusive. In current situation, we might worry that the resolution of ultimate uncertainty is going to take some time if the election is close or contested.
The bright side of that for investors is that most of that volatility can usually set up some pretty good buying opportunities, because what will happen? The markets will adapt. The market will just get used to whatever the new circumstances are, and it will continue to go higher. Barack Obama, a great example for that. They're certainly not the kind of person you perceive as being a friend to Wall Street, but the market did great during Obama's 2 terms in office. So it's just a matter of adapting, adjusting, getting past that initial bout of volatility and figuring out what you're dealing with.
Certain firms like LPL Financial have also tried using past market data and performance to predict who would win an election.
When you get within 3 months of the election, which is about next week or so, how stocks do has a really good track record for who might win. Now, here's what I mean by that. If the S&P 500 is higher, the incumbent party tends to win. And if the S&P 500 is lower, the incumbent party tends to lose. Think of it like this. Stocks have been right every single year since 1984, and they've been right 20 out of 23 times all the way back to the late 1920s. That comes out to an 87% winning percentage.
If the stocks are right again this year, the winner would be the incumbent president Donald Trump, after a slow market recovery since the beginning of August. However, some market experts remain skeptical of drawing foregone conclusion based solely on market data.
Every election is different. Every election is different because the candidates are different. Every election is different because the environment is different. So I think you have to really just think about where we are, what the policy differences would be, what the personality differences would be, what the configuration of Washington overall would be after the election. You've got to factor all that in making investment decisions, but you shouldn't just resort to sort of a back of the envelope, this is what happens with elections, because I just think that that kind of calculation is pretty crude and not very useful.
So what happens once the vote has been cast and tallied? According to a study from the US Bank, stock market returns tend to be slightly lower after the year following the election. JP Morgan also discovered that in the short term, markets tend to react more positively right after the election of a Republican president, possibly due to the preconception that Republican policies are more market-friendly.
Especially when an election was close, a surprise or kind of near surprise outcome where a Republican president is elected corresponded to a positive market reaction, and a surprise or kind of close election result in favor of a Democratic candidate produced a negative market reaction.
However, in the long term, it's a different story.
If we look at the entire presidencies, the stock market performs on average much better during Democratic presidencies than the Republican ones. So the bulk of positive returns in the market actually are earned during Democratic presidency. This could be a bit of an artifact of the timing. This could be an artifact of the timing because if we look at the past presidential elections, Democrats are more often the winners in a recession, whereas Republicans are more often to gain power during an expansion or close to a peak of an expansion.
Changing the resident in the White House also impacts the market. Analysts found that stock market gains averaged at around 5% when a new party came into power, compared to 6.5% when the incumbent president is re-elected for a second term.
During the first term of a new president, there is still some uncertainty about what that president's policy is going to be. And so the market valuations might reflect that uncertainty. Whereas a second term of any president is typically going to continue the policies of the previous presidency, of the first term of that same president, and therefore there's less uncertainty for the markets to process, and therefore that might contribute to higher valuations during that second term.
In case of general elections, congressional results could impact market performance. Similar to presidential elections, which party controls Congress is not a factor to equity performance. However, history has shown that the market performs better under a divided Congress, as there is less chance of drastic policy changes.
So the market will do well with a Democratic president, a Republican Congress, or a Republican president and a Democratic Congress. A great example of that was during Bill Clinton's time in office. Most of the time that he was there, he was dealing with a Republican Congress. Same thing for Barack Obama, had to deal with a Republican Congress for a good portion of the time that he was in office. And the market tends to like that gridlock atmosphere because they figure, we don't really trust you guys anyway. And by having a split party thing, well, it kind of helps to make sure you guys don't break anything while you're there.
Whatever the result might be, a majority of investors do agree that the presidential election will have an impact on the equity market. According to a recent survey from Hartford Funds, 84% of investors said the 2020 election results will impact their investing habits.
I only see more uncertainty ahead just because the election is probably going to be close and the result is not going to be settled for quite some time. And so I would say the risks are definitely on the horizon for investors.
However, almost every expert unanimously agrees that placing stock bets based on politics isn't a great idea.
First of all, people are biased. People always think that their favorite candidate is going to be best for the stock market. Second of all, people think that they're able to predict how the election is going to turn out. And as we've learned in many elections, we really don't know. And finally, people think they know how the market's going to react when you get that election result. I know a lot of Republicans thought the market was going to go down when President Obama was elected. I know a lot of Democrats thought the market was going to go down when President Trump was elected, but in fact, the market went up both times. So if you're biased, you don't know what the outcome is, and you don't know how the market's going to react based on that outcome, you really shouldn't make an election bet.
The 2020 election is also likely to be very different from any of the past elections, given the state of the economy suffering from a national pandemic.
I think investors usually think about the economy as being the most important thing when it comes to investing. But the truth is that the fate of this economy depends upon the virus itself. Until we control the pandemic, we will not have a healthy economy. So I think as people think about investing, think about voting, the most important thing is how do you deal with the pandemic? Because if you can deal with the pandemic, get past the pandemic, then the economy will recover. And that should be good for portfolios.
The outcome of an election can have an entirely different effect on different sectors, making predictions for future market performances that much more difficult. The gridlock in Washington and the results could also have a different impact on the market in 2020, as many sectors are counting on more stimulus during the pandemic.
Healthcare is going to be huge in this election to just how the results will determine the future of that sector. It's anybody's ballgame right now, but after the election is over, you'll see investors really start to put their chips on the table in terms of where they think the future is going to go.
Success will ultimately depend on how much risk an investor is willing to take.
And of course, the more risk-tolerant person will invest more in stocks and reap the benefits. And the more risk-averse people will perhaps stay more on the sidelines and potentially miss the gains as a result.
I think as an investor during a time like this, you want to make sure you've got your bases covered. So it really is some of the old time diversity, those kind of things.
Remember, any timing decision when it comes to investments really means you can make two good calls. You know when to get out and you know when to get back in. And I've never met anybody who can consistently make one good call on that. So I would think that the right thing to do is think about where you want to go in the long run. What are you trying to do with the portfolio? Think about valuations and place your bets accordingly. And try not to try and time investments around an election.